Hi, and welcome back to Channel 11 News. I'm Ken Shinoda. It's Thursday, October 28th. I've got Barry Bannister here, equity strategist with Stifel. We've got stocks hitting all-time highs. We've got uncertainty around inflation. We've got a slightly inverted yield curve, finally, with 20s and 30s. It's like a basis point, but it made the news tonight. So a lot of uncertainty out there, and looking to hear from Barry. Thanks for joining us about his thoughts on the markets.
Thanks, Ken. Appreciate it. So we were very positive just 2.5 days before the low in March. On March 19th, we wrote a note saying that the S&P would rise 15% in 6 weeks. 2 days later, the market bottomed on the 23rd of March when Powell backstopped everything. And we rode that rally from 2,200 and change on the S&P up to the high 3,800s. I've been early, but I've been more negative on the market. I'm trying to look out farther and see things that are worrisome. And, you know, inflation was certainly coming, and that was an issue with essentially using debt to create demand when there wasn't a profit motive to supply it initially, and you had pileups in the supply chain. But also, we think that as we get closer to taper, and it's in the best interest of the Fed to lean against an asset bubble, that the Fed, particularly after Powell's reappointment, which I expect, the Fed would probably tend to force us to be more overweight a defensive profile, not a cyclical profile. And we are approaching kind of a barrier that's been in existence now for 23 years on cyclicals relative to defensive. So think of that as cyclicals being everything from financials, energy, industrials, materials, and so on. Technology is even cyclical, believe it or not, relative to consumer staples, healthcare, utilities, telephone companies, some real estate. That's defensive. So cyclicals are a little overbought. Defensives can have a bounce. The market's at risk of correction. And we wrote about it in this note.
Great. I've had a chance to look through some of your slides, so would love to have you kind of share them with the rest of our viewers.
Yeah, a couple of slides I think jump out at me. One is this question of the Fed. You're probably familiar with the Shiller-Cape PE. It's useful for long-term forecasting, so it tells you your forward 10-year return with great accuracy. Doesn't really tell you much about the short-term valuation, of course. But we take the Shiller-Cape PE, which is on GAAP earnings, and I convert it to operating. So I use the operating earnings of the S&P, which are naturally higher. And if you do a operating conversion and you do a PE on a 10-year average, trailing 10 years of inflation-adjusted operating earnings, you get the price over normalized earnings or full cycle earnings. The PE ratio on that basis since 1920 monthly on this chart here on page 3. So the 1920s roaring 20s bull market, which burst into a bubble and then burst. And by 1932, thousands of banks had failed. The New Deal rally, and then, of course, a reversal of some of the easy policies in World War II happened. The huge bull market into the late 50s and 60s. And then the 70s bust, Paul Volcker and inflation breaking, and of course, the inflation driving up interest rates. Then the enormous bull market from 82 to 2000 that reached bubble stage around 1997, 98. And then a bust that took us in the tech bubble down 56% on the S&P 500 in 2 years, rescued temporarily by the housing bubble by Greenspan, but then ultimately that busted in the financial crisis, and you were right back to the lows of PE ratio. So the uptrend, which is easily explained in the footnote 1, but the uptrend is now parallel to the uptrend. We are in late 28 or mid 97, you can call it, to be charitable. And we could easily go to 45 times 10-year average operating earnings by 2023. So it's 145 in 22, it'd be about 150 in 23. And that would be 6,750. And it would duplicate that kind of 1998, 99 last run of the bubble. The problem with that strategy is if the Fed allows that to happen, they will have to rescue this bust on the other side. And if you're financing populist government and rescuing the wealthy who own stocks, 90% of the stocks owned by 10% of the people, then you lose your independence. The Fed would lose its independence. I have absolutely no doubt. So granted, Chairman Powell has been almost obsequious in his approach to the administration and Congress, but I think after reappointment, he would have to lean against this asset bubble and forthwith signal, taper is starting. There will be rate hikes eventually. We will still have negative real rates. We're still very accommodative. So we spend a lot of time on that here, and then we get very detailed. We talk about a very short-term forecast. We think in the next 4 months, 5 months, there's going to be a drop in the US PMI manufacturing, a pop up in the dollar on flight to safety, and Fed being more aggressive than other central banks. China slowing down, and that's going to affect China's ability to keep the currency as strong as it's been. So the dollar pops up. The financial conditions index worsens a little bit, just a little bit, coming off 40-year lows. Maybe it goes to slightly above that. And the supply of global M2 money, which is on Bloomberg, GLMOSUPP. It's the entire world's M2 money converted into dollars. And the rate of change in that peaked on March 22nd of 2021. And it has been decelerating since then. A stronger dollar, Treasury rebuild of its reserve balances at the Fed. This would all force global money supply in reverse. So that pushes you into these defensive trades. Things like healthcare and staples and utilities and the foods and beverages and tobaccos. And it would force you out for the direction of cyclicals, everything from most of tech, excluding the internet, but most of tech, excluding internet. And it would force you out of like semiconductors and force you out of capital goods and even take you out of autos and so forth, banks. So if I do just last chart, and then I'll segue back to you, Ken, cyclicals relative to defensive. So these 13 industries, equal weighted. Relative to these 11, defensive, more or less defensive, but not all, but most of them are defensive. Cyclical defensive ratio. I get this chart. Since 1999, that equal weighted cyclical defensive ratio has followed a very long curve trend. Deflationary era for our time, where it was very hard for cyclicals to get a bid. Prior to the financial crisis, they always stopped out at the red line, 2 standard deviations above the trend. After the financial crisis, at 1 standard deviation. Now we're reflating very firmly at 2, but whenever we reach the top, and I think it's a preliminary top, we get a drop in the PE ratio. So the CAPE PE, the PE on 10-year average earnings, falls abruptly, which is 4 multiple points would be about a 570-point correction. That's what we're looking for.
Yep.
So just looking at post-COVID, there's your COVID sell-off, there's your rally, there's your first cyclical. We played that. We missed this one, but we're getting within days, I think, of that one, and we're going to top. So I would be very worried if I were an investor around the time of the Fed November meeting and after the announcement of Fed Chairman. I would be a little worried about the cyclical trade, particularly as we get November data for the slowdown in China, infecting Europe, and other factors there.
Yeah, I mean, I looked at it a little bit more simplistically. I mean, we've just had such low rates, such negative real yields that as policy starts to, come out of this insanely accommodative stance, as you've mentioned yourself, QE4 was the same as QE1, 2, and 3 put together, and perhaps we did more than we needed to, and it's lasted way longer than it should have. If you look at Fed funds relative to wage increases, looking at average hourly earnings, we would have been hiking maybe even as soon as earlier this year, right? What are your thoughts on that? I mean, is the Fed behind the curve already?
Yeah, there's no question. They chose to be. I mean, they've been what they call credibly irresponsible. They're trying to generate inflation after many years of not hitting their 2% goal. The way that we look at it is this. If you take a look at this page, We look at something called permanent unemployment, which is the long-term unemployed, not the temporary layoffs, which is excluded. It's just the unemployment rate for the longer-term unemployed that are still in the workforce. And that permanent unemployment rate from the CES of the households survey, that permanent unemployment rate bottoms at about 125. You see it here since 1990. What's remarkable about the COVID era is that everything happens quickly because of the deficits. If you do a deficit, you create dis-savings in the government, which creates consumptive ability on the consumer side and business side. And so you get investment, you get consumption, you get too much demand relative to supply, you get inflation. But you're seeing the unemployment rate, permanent unemployment rate plunge. It's the fastest drop in all 60 years of history that I've looked at recently. It took many years after the Cold War ended, tech bubble burst, and after the financial crisis, many years to get to the level we'll be at by the spring, certainly by March, February of this year, early next year. So if I look at Fed funds minus neutral, Fed funds minus neutral, or R star, I get a spread, and I detrended it. It's obviously trended down for decades because the Fed can only go so high before they blow us up. And that spread detrended shows that over tightening in 98, the over tightening in 2000, the over tightening in 07, the over tightening in 2018. But hey, like you said, Ken, how much is too much? I mean, we're 200 basis points plus below where we would be in a normal Fed environment. We should be at 2% interest rates by the end of the year, but we're at 0 and staying there through the end of the year and certainly through the middle of next year. So it's triggering an asset bubble, and that's problematic. The problem with letting a bubble get out of hand is that when it bursts, it triggers a loss of independence for the central bank, and that's the risk that they're running here. They just don't seem to either get it, or maybe they're just on the run because of the changes in Washington, and they're afraid to say what they really think.
Yeah, well, in 18, we got to like 2.5. I know you believe that it's lower than that. So why is it that this time around you don't think we can even get past 1% on Fed funds? I mean, that's not based upon the dot plots. That's by 2024 we should have 4 hikes.
There's two Fed rates. There's two Fed rates that I'm looking at. One is just your obvious Fed funds, or IOR, interest on reserve balances, IORB. And then the other is what's called the shadow rate, and it's based on the shape of the curve. So if the curve is very steep and then flat at the front end because of the zero rate bound barrier, take away the zero and you get the true short rate. It's below 0. It's called a shadow rate.
Yep. We look at that at Doubleline.
Yeah. And at 0 bound, you take over with the shadow rate. So here's Bernanke's 0 rate era all the way through Yellen's first rate hike in December 2015. So there's a shadow rate went down. And here under QE4 with Powell since COVID. And what we looked at is that Fed funds, or shadow rate at the 0 bound, minus the neutral nominal rate. The neutral nominal rate is simply R star, the neutral real rate, plus core PCE inflation year over year. So that's your nominal neutral rate, the rate that's neither tight nor loose, the rate consistent with full employment and price stability. The barrier or fence line, if you're on one side, you're tight, the other side, you're loose. And Morgan Stanley does that calculation using Dr. Kripke's methodology. It's called MSRAUS here in the footnotes. So what we did is we looked at that Fed funds minus the shadow. Are they tight or loose? The trend for decades is down, down, down. Lower and lower levels that are absorbable by the market. And if you detrend it, so movement around this blue trend, you get the detrended line, and you see that at precisely a 225 spread to neutral, the Fed blows up the market. So here we blew up Indonesia, Russia, Brazil, Thailand, and long-term capital management. Here, the tech bubble, which really lasted to 2002. Here, the financial crisis in housing. Then we had a debt crisis, and the European debt crisis, and that was different. Then the Powell sell-off in fourth quarter 2018, and even when COVID hit, we were still too tight, and we had a bear market. Now, calculating the peaks and valleys of this line is the red and the blue. So at peak tightness spread to neutral, it's the red dots. The blue are the trough. And I would argue that, look at the Fed funds. is lower highs each cycle. So 1% looks like it's going to be the peak. And that is, according to futures, around between December of 2023 and January 2024. Yeah. And so we're already tightening with the taper, and then we're going to do rate hikes slowly. And I would say that your risk of a bear market is more like early 24. But in between now and then, mid-cycle policy dynamics and risk, I would say you get frequent corrections. And that's what we haven't seen in quite a long time.
Yeah, I mean, it makes sense. The Chinese slowdown is happening, I guess. So you're of the view that they're not going to kind of flip and turn more dovish from an accommodative stance, given what we're seeing over there right now.
Well, it's a chicken and an egg, right? So I think eggs have to break before the Fed turns chicken again. So the Fed has an interest, I think, after November, after reappointment, after watching the inflation data come in and so on. They have an interest in fighting back a little bit against a bubble, but then they would trigger a correction in the process. After that, the Fed may fold like a lawn chair, and then we would have a rally back up. And that's very likely because of their history. So
yeah, based on Powell's activities in 18 and 19, seems like that's almost the base case.
Yeah, Powell's so far, as I said, he's been so obsequious to the wills of the populist administration, and Larry Summers has criticized that. If Powell had a put option, it would be $1 below the market, right? So he's not a particularly aggressive individual here, it seems, but the Fed board with next year's appointments might get slightly more so. You mentioned China. Nobody's looking at China, and I think it's extremely important. If I look at Chinese stimulus as a percent of the Chinese nominal economy, advanced 7 months. So it's the growth rate of stimulus as a percent of the nominal economy. It's the stock, not the flow. The stock of stimulus that they put into the system. Year-to-year change, advanced 7 months. It says that by next March, the global PMI, which recently was 54, would drop to about 49.75. And if the global PMI drops to 49.75, then with a lag, you see the US PMI held on the last 2 tightening cycles. Boom, it goes down to close to 50. And if the year-to-year change of that US PMI goes to close to 50, and it's down 20% versus 60 a year ago, then by March, the S&P would be flat or up 5% versus March. In March of this year, it was 3,900. So we could easily be at 4,000, 4,050 by February, March at the latest, 2022. Because of this slowdown that China's already advanced 7 months, already forced onto the world.
And so what do you think as far as the bond market, long-term bonds? Clearly, short-term rates are headed higher with the activity of policy, but long-term bonds, are you neutral given your stance on inflation, or are you more bullish given your stance that not only will inflation maybe not be as much of a concern, but that growth is going to turn over?
Well, we've spent a lot of time on this and written recent notes about it. Believe it or not, the 10-year, even though the federal government's average maturity ranges, I think, from 30 months to 70 months, the last 50 years of maturity, the average maturity of the federal debt. And currently it's closer to the higher end of that range. I think about 64 months, 63 months average maturity. But believe it or not, the 10-year yield correlates very closely to the overall interest burden as a percent of GDP of the federal government. And we would bring back an environment like the late 80s, early 90s of the bond vigilantes at anything approaching 2.5, 2.75 on the 10-year yield. So the Fed, like 1942 to 1951, first to pay for World War II, and then long after the war was over, because populists loved that, that the Fed would have to cap the 10, prevent it going above low to mid twos. I do not believe we will see more than 2.5 in the next 15 years. But on the short end, one more shock, one more big shock, one more bear market, like if we go to 6750 S&P on an outright bubble that the Fed unfortunately lets happen, which is at a -1 TIPS yield, which is about what we're on trend now. That's the trend level in the year end next year, meaning 2023 December, the trend would be -1, the 30-year trend for the TIPS yield. That at this positively sloped curve, but with a repressed real yield and a very inflated market, What would it take to get to 67.50 in an outright bubble that the Fed foolishly let happen? Well, as I said before, that's 45 to 50 times Cape 10-year operating earnings. And what would that be? That would be a mistake. So yeah, I think you're going to probably, in the next downturn, the big bear market off that level drop to near zero on the 10. And then the Fed is done, they're toast, their history. They might as well just take memos from Treasury, Congress to what to do. And that is the risk by mid-decade, like 2025. But again, we're not going to worry about that yet. We're just worried about the next 4 to 5 to 6 months. But I think your 0 to 2.5 range on the 10 is the range for the next 5 years.
Okay, pretty long time frame to think about. But maybe we'll get there to zero. A long ways away now. All right. Well, we've talked about correction in equities. The Fed can't let a bubble happen. Definitely does seem like they're headed towards tightening. We've also talked a lot about kind of commodities. They're way equities have massively outperformed commodities, and is that something interesting to look at as one of the other places to be?
Yeah, Ken, that's a great question. I mean, for over 20 years, I used this chart back in 2001 to say that there would be a commodity boom for the next decade, and we did. We had one. And I've been watching this for many, many years. Since 1910, 111 years ago, monthly, you just take the S&P composite or S&P 500. You can download the data from Schiller. And then we have commodities, which I show in the footnote. And I can send you the index if anybody wants it. So S&P divided by commodities is paper versus hard assets. And if you put it on a polynomial trend for over a century, you get an upslope. No dividends here, just price to price. And it put you in stocks. It put you in stocks for the last 11 years in tech from minus 1.5 sigma to plus 1.5. Just wanted FANG. It put you in stocks from 1982 to 2000 top, put you in stocks from the late 40s to the late 60s. And it put you in stocks in the roaring 20s. And then you knew when to buy on the 1932 bottom. You knew when to buy after World War II. You knew when to buy, tried twice, but then you finally succeeded with 82. And you knew when to buy with the financial crisis low and then the double low in 2011. So when this line goes up, and I don't think we're going to have a bubble, but if we do, it will look just like this. We'll go well above 1.5 sigma. It won't top out like the late 60s. If we go like 29 into a bubble, then we will. But the way to look at it is stocks relative to commodities. That's all this chart is, now at the highest levels in 100 years. And then growth relative to value. It's the same trade. So a bubble would take us up to here on growth-led markets, 67.50 easily. Or if it's value, we're truly going to reflate. Dollar's going to weaken, and that would be more like the tech bubble bursting. That would be one of these 10-year down cycles where value beats growth. That happened, in the 70s. It happened here. So we think it's a little early. I'm on the fence on this one, but I am watching this chart, and that's the way to think about commodities.
So if we see this the chart continue to turn over, and you think we're in a new paradigm, you think, I know commodities have run up a lot. They're probably up over 70% from their lows of last year, but you think room to run then, I guess, right?
Yeah, commodities are definitely cyclical, and that's the thing that we all have to remember. This is commodity prices starting in the year 1795 monthly. So again, all of our sources are down here with links to the books and whatnot. Commodities run up, usually a war, and then they fall down, and they run up and fall down. And that's a cycle, okay? And 2018, before Powell over-tightened in the second half, fully offsetting the Trump tax cuts, causing that 20% sell-off in the fourth quarter 18, double dipped and hit the bottom again in April of 20 with COVID, but have rocketed up. Commodity growth is the 10-year CAGR of commodities. Value versus growth follows the same cycle with a lag. And we think that, by mid-decade, we'll firmly establish a value cycle. Now it's just a teetering cycle off and on. And so I would bet, the commodities are up. And unfortunately, these things never end well. When you have a commodity low and you have deflation, it rewards people who have money because of high real returns to money. But then that segues to political populism, Jacksonian democracy, the progressive era, the New Deal, and now populism. And then you reverse that and commodities go up in waves till you ultimately have a conflict, whether it's on the scale of a civil war or World War II, World War I, or just Taiwan, Mideast, Ukraine, cyber, and the war on climate. One way or the other, this will go up by the 2030s, and you'll be at a 7 CAGR, which tells me that from this point to 10 years later, roughly, commodities will double, all of them, as a group. So, this could be how they make this transition to electric cars. They're forcing oil prices up to the point where people say, all right, I'll buy an electric car. And that's what I think is happening. And I think that the risk, I'm a big geopolitical reader too. I read everything. But, Taiwan is definitely a high risk candidate mid-decade. Mideast, Iran, Israel, and the nuclear, it's definitely a big risk mid-decade. Ukraine, Eastern Ukraine. If I was Putin, I would take Southeast Ukraine because I need a land bridge to the Crimea to supply the Black Sea Fleet so I can control the Eastern Mediterranean. And cyber is a huge risk. And of course, this climate constricted supply on energy. So yeah, commodity cycle is coming. The question we have, is it going to be quick like the Great Depression to World War II? Or is it going to be real slow like the Progressive era followed the Gilded Age and takes you all the way to 40 years to get to World War I's peak? I don't know.
Yeah, I mean, it's the markets have been very fortunate the last 20, 30 years. JP Morgan had a piece out, they called it the Great Moderation. Low growth, low inflation, accommodative policy from central banks, globalization, lack of wars out there, and higher commodity prices, something to fight about. And that's definitely something that could be on our horizon. And the markets really haven't had to deal with that in quite some time. And now we have kind of more volatile growth, more volatile inflation expectations, more volatile central banks, as you're seeing kind of in the last couple of weeks. You've seen a bunch of surprise hikes on the front end, Canadian Central Bank this week, and just seems like a more volatile period ahead of us.
Yeah, and JPM just today said that, the Fed won't follow other central banks, and they referred to them as smaller central banks. Well, maybe I'm too sardonic to be, just bubble boy. I don't know if you saw Seinfeld, but bubble boy,
Yeah.
I'm a little sardonic and it's hard for me to play the bubble boy role. I mean, I know that we could have a bubble. I could easily justify it at a 3% CAPE operating equity risk premium, a -1 TIPS yield is a 2% implied earnings yield of 50 times 10-year average real earnings, which would be around 6,750 to 7,000. I can get you there. But I can tell you that once you get there, the bus will crash, okay? The bus will get you there, but you will crash. Nobody ever gets there without crashing in history. And so if that's what they want to do, then the slightest second derivative change in policy, slightest interruption on the geopolitical front, and kaboom, we're down 50% in 2 years. And we've been there in 1973, 70, late 73, 75. We were there 2002. We were there 2932. Worse than that. We can do it. We can do it very easily. But it's stupid policy. There's a difference between getting the market right and then trying to get policy rational and right. And if you believe in policy errors, including errors of omission, which the Fed is doing, then yes, a bubble is possible.
Well, it seems like the Fed's in a rock and a hard place. They've got inflation here today. They want to follow the path of raising rates, and I don't envy where they are. Seems investors should be cautious, at least in the near term. Could be a decent buying opportunity, maybe early in the next year. Maybe long term. Commodities haven't worked for quite some time. I know we were kind of bullish in 18, but it was early, as you've noted. So maybe adding a little bit of commodity exposure is probably not a bad idea. What about any view on gold and cryptocurrency? Gold historically being, one of the inflationary hedges. Perhaps it's losing its luster, or do you just think you'd rather own a diversified basket of commodities?
Gold's been relevant for 5,000 years. I read an article once that documented that you could buy the same number of loaves of bread in Paris with an ounce of gold 500 years ago as you could today. That a suit of armor and a fancy suit today would cost the same thing in gold terms. I even calculated the box office of the James Bond movies in gold equivalent. Just Auric Goldfinger would be very proud. And Sean Connery came out on top. He had the most box office in terms of ounces of gold. So gold is very relevant. If you took the SPX divided by gold prices for the last 50 years, we really haven't rallied beyond the last major tech bubble peak. So gold is still relevant. Anyone who writes it off, please give me their gold. If they don't want it, I'd like to have it. But if I look at the year-to-year change of gold prices, so this is year-to-year change of gold. And then I look at what's called equity risk premium, earnings yield minus tips yield. Currently, it's 3% earnings yield minus a minus one tips is 4, so you have a 4% equity risk premium. As you know, a 3 earnings yield is a 33.3 PE. That the change in the level, so it's called year-to-year level change. So if the equity risk premium goes risk off and we have a sell-off and the equity risk premium rises a full 100 basis points, from 4 to 5, we could still be at a tips yield, but our PE multiple would compress. We'd have a bear market. So in a bear market of 1% increase in equity risk premium, you'd be up over 25% or so in gold. On the converse, if you're down 1% or 2%, gold is either down 5 or 20%. So gold is going to be a hedge against, the market. The market's down, gold's up. On the other hand, Bitcoin, in the 10 years we have of history on Bitcoin, the level change versus a year ago's price in Bitcoin moves in the other direction. So that if equity risk premium rises, Bitcoin crashes. If equity risk premium falls, Bitcoin goes to 100,000. It's very much opposite. So it's a momentum speculative instrument, not a hedge. It's a liquidity-driven, momentum-driven market, bull market type, low equity risk premium speculative instrument. And I would be leery if the market's expensive to pile on, but I wouldn't be short in case we have a bubble. But if we do have an equity bubble, it's probably the most powerful short you could possibly have, because it would lose so much of its value on the way down.
Yeah, that NFTs, all that stuff. It's the too much money flowing around the system. The TINA. That's a lot of this stuff's been driven by it. I think we'll look back and maybe the tulip bubble will be even more rational than some of the things that we're seeing these days.
Yeah, Nassim Taleb was on CNBC this morning, and he doesn't go on TV very often, so I tend to listen. And I've enjoyed his books. And he said that if you give people free money, they invent things to do with it. So I thought to myself as I was driving, I thought, yeah, they do purple dancing horsey, horse NFTs, and they pay for that. But free money, which has been the COVID strategy, has been vastly excessive. If you think about what World War II cost in dollar terms in today's money, it was calculated by one of the military academies in a paper as 4.4 trillion, 4,400 billion for World War II. The total spending, every single dollar we calculated what the government has spent since COVID was announced, the first stimulus, remember, it was 8 billion or so with Chuck Schumer agreeing to an $8 billion quick deal. The very dollars is 5.4 trillion. So we spent $1 trillion more on COVID than we did on World War II. And when you translate that through government dissaving into private sector consumption, you got earnings. You got $200 of S&P earnings, a very high multiple, suppressed real yields, a high market PE. It is reality. I think it's dumb policy. World War II was an existential threat to the United States, but this is not. However, we did what we did. And the reality is all that money floating around is looking for a home. And that's why it's inventing new ways to put it to work.
Yeah, we've talked about here at Doubleline that a lot of the, this year's demand and the reason GDP's up a lot, I guess it came down in the third quarter, was because of the stimulus. And as the stimulus fades, Of course, growth will fade, but I've heard you mention that while stimulus, the direct payments to consumers has ended, the savings rate is very high. And we see that when we look at consumer credit and low delinquencies. And do you think that that savings rate is enough to kind of maintain a positive growth and keep the markets moving forward?
Yeah, I mean, the savings rate went from ludicrously high to ridiculously high. So ludicrous to ridiculous. It's been downtrending a little bit, but there's over $2 trillion of excess household savings. So, if you look at, I don't know how many households there are, I think it's like over 100 million. You got almost $20,000 average, per household of excess savings. You wonder why people drop out of the workforce, like middle-aged boomers with inflated stock portfolios and houses, or second earner spouses drop out of the workforce. You wonder why. Just look at what you just did. You inflated their asset values and gave them tens of thousands of excess savings. And you told them to stay inside for a year and a half on COVID. So all the 25% of income that they would have spent on entertainment, they didn't spend. Then they placed orders for durable goods, but there wasn't the productive capacity to buy those durables. And you end up with a pileup with higher inflation that erodes real earnings power for people who actually still work. I think it's been the worst, most idiotic policy I've ever seen in my whole life. And I've been around since Roman era times because I'm like Highlander, I've been around forever. It's just dumb, it's been dumb. But the Fed did it, can't help it. And Treasury, it was an election year. So both sides, Trump and Biden, were falling all over each other to try to spend money. We are where we are. But meanwhile, China didn't do any of that, and they just built hypersonic missiles. So, you want to bet on somebody who's made good policy choices in some sense. China. It's very real what they're doing. China's made the right choices, and all in all, I think the only thing China's done wrong is over tighten. And you can't have your cake and eat it too. You can't have growth and unwind a 25-year real estate boom quickly. Yeah. So China's going to pay a price, but that's why Xi Jinping has sort of absolute power, so he can impose difficult conditions on people.
Yeah. Well, Barry, thanks so much for the interesting views, and for our investors, let's stay cautious out there. And I hope you have a great weekend, and we hope to talk to you soon.
Thanks, Ken. Enjoyed it.
All right. Thanks, Barry.